In this summary video, I'm going to cover the basic characteristics of a bond, who uses them, the types available, and how they're priced. All this information in your reading can be found in Web and Brahma, Chapter 7, where there's 32 pages devoted to bond market, and this is what it looks like. So, what is a bond? It's a debt instrument that pays an interest rate, which is known as a coupon, and then at the end of the bond, the investor gets the par value back. So an example could be an investor would buy the bond at the market price. So say this is £120. They might buy this bond. It could be an annual coupon. So every year they'll receive, say, simple interest of £2. So every year they'll receive £2 on the £100 par value, a 2% coupon. And then at the end of the bond, which could be in 40 years' time, you'd get back your final £2 payment plus the par value of 100. So it's a simple interest debt product. It will always have a determined amount in form of coupon, and the par value will be written on the bond. How long do these last for? Well, typically, each bond is characterized by its maturity date, i.e. when does the bond end. So if it's 30 years from today, the bond will have a maturity date in 2050. So this would be a long-term bond. Usually we categorize bonds in the length they're in issue. Shorter bonds typically less than 5 years, medium bonds 5 to 15, and longer would be plus 15. Anything below a year is not a bond. This is typically a commercial paper in the money markets. Also, bonds can have no expiry date. These are known as perpetual bonds, where the bond holder will just hold this bond until affinity, and you'll receive an annual or semi-annual coupon payment for the duration as a holder. Typically, perpetual bonds are callable, so they can be paid off by whoever issued them at any point in time. So, each bond has what's known as a contract behind them, which kind of explains the likes of restricted covenants. This could be a bond that has to be paid ahead of any dividend payments from equity holders. If this bond is in a certain pecking order, it could be in the first instance, in the event of company default, this bondholder gets paid back first relative to other bondholders. They can also have different protections, the likes of early protection. There can be like an insurance policy attached to them, but this is all noted in the legal document behind the bond. So, who can use the bond? Typically, they're issued by governments, which are known as gilts in the UK. So the UK government issuing debt for more than 1 year is known as a gilt. The government will issue the bond by the Debt Management Office and obviously pay the coupons until the maturity date. Local government can do this too. And finally, companies, large corporates with a good credit rating, can also issue bonds as a form of debt, rather than the likes of selling their ownership. It does have its benefits. For instance, coupon payments are tax deductible. If you sell shares, then you're selling your ownership. But if you're selling lots of bonds, remember this is debt. The more debt you sell, the more you have to pay back. And if you have a large debt to equity ratio, then this could be seen as unsafe. Who can purchase them? Well, really anybody. Individuals typically do it for their brokers or their market makers. But if you're going to trade bonds, you have to be a gilt-edged market maker authorised by the London Stock Exchange in the UK. Typically, investors in bonds are more risk averse, or they do it for the income, i.e. the coupon payments, rather than the capital gain of the bond price moving up or down. Here's an example of a typical notation for a UK bond or gilt issued by the UK Treasury. All you'd see is the word Treasury, the person who issues it, 3%, that being the simple interest coupon. If it's £100 par value, you get £3 a year. and then it'll always have the end date. In this one, 2025. If that is PEP, then it would be a perpetual bond, i.e. it doesn't have an end date. So this is the typical notation. This is what's known as pretty much a standard bond. The terms differ depending on the textbook. They could be straight, plain, vanilla, bullet. This just means they can't be paid off early. If it's a bullet bond or a standard bond, it does what it says on the tin. It'll pay this coupon rate until this end date and nothing will change. There's something called a zero coupon bond, which is like some of the discount products we talked about in the money markets. So a zero coupon bond doesn't actually pay any coupon payments. All it does is pay the par value at the end of the bond. So you may buy the bond, say at £50, and then wait a couple of years and you'll return back 100. So it's what's known as you pay a discount and then at the end you'll get the par value. Some bonds have characteristics that lower their risk. So they could be serial bonds, for instance. This is where you don't have to wait until the right to the end to get the par value back. What the bond will do is at every coupon payment you'll get a little bit of the par value and the coupon payment. So the very last payment will be the last little bit of the par value and the final coupon. But interestingly, if you look at the way how these work, the coupon amount, even though it's simple interest, will get lower and lower and lower towards the end of the bond. That's because the coupon interest is being paid on a smaller amount of par value. Don't confuse this with a sinkable bond, even though a sinkable bond is the one you'd think is the one where the principal's paid back sooner. A sinkable bond is actually linked to a trust, so the coupon payments are paid into a trust with the par value, and this just ensures that by law, when it's in trust, it's a bit more safe for the eventual investor who receives the payments. If they pay some of the principal back off early into trust, therefore that means the coupon, when it gets the par value payment at maturity, they will not default because it's been paid into trust. There's other form of bonds that issue different securities. So you could have a bond where if the company doesn't pay the coupon, go to default, the investor might have a claim on the likes of a property, some collateral, something else from the business, some other securities. Some bonds are higher up in the pecking order than other bonds. So if the company goes bankrupt, certain bonds might pay out first on what's left. If you're the bondholder at the bottom, then you'll get what's left. If you get paid, then that'll go down, the rest will go down to shareholders. Or you can have a bond that has a kind of guarantor where if the bondholder defaults, someone else pays you. But obviously the company issuing the bond would have to pay for this service with the external party. You also have bonds that are a bit more flexible. So rather than the bonds that are known as bullet or vanilla, you have bonds that could be convertible. So this means at some point in time or at some price level, the bondholder can convert the bond into shares. Now the question is, why would you do this? Well, if you're a bondholder and the share price is very valuable, it might be better to turn it into shares immediately than sell and have the capital gains. But do bear in mind the tax implications of doing this. So you also need to bear in mind the risk characteristics. If you turn into shares, then there's no guaranteed income like there would be with a coupon payment because dividends are not guaranteed. And obviously share prices can be more volatile than bond prices. So there's these risks to factor in. A floating rate bond is a bond where the coupon payment is actually linked to something. So it could be index linked, it could be inflation linked. So instead of a fixed simple interest, the coupon payment could then change depending on market rates. And a puttable bond, that gives kind of the holder of the bond the right to sell it back at a set price. So if the investor wants to crystallize their cash and sell the bond, you can sell it back to the person who issues it. There's also something known as callable bonds, which is the opposite to puttable, i.e. the person who issues the bond the company or the government, they can call the bond back when they like. They call it in other words, they pay the investor the par value back, and that's the bond ended. Investors would want to be compensated more for this if it was callable, because bondholders like kind of certainty. They kind of want to know that they want the steady stream of income payments. But if the company or government just call it straight back, then that's all gone. So coupon rates on callable bonds tend to be a little bit higher to compensate them for the fact the bond could be recalled at any point in time. Now, if you're an institution that issues callable bonds, this could benefit you, because if you're paying a fixed coupon bond at 5%, and then market rates have dropped to 1%, then you may as well call the bond back and pay for it using another bond. So you could issue a bond at 1% to raise the money to pay back the bond that was paying the 5%. So it could be a way for you, the company or the government, to lower its interest payments. Here's just a quick look on Bloomberg to show you examples of what it looks like. So at the top there you've got gilts that are, so this was taken in 2018, this image. So you can see they had like a UK Treasury bond issued at 1.75% to be paid back within the next year, and you can see the price. Look how close that is to 100. That makes sense, because if the par value of a bond is £100, as you get close to maturity, if you're going to buy it in the secondary market, you're not going to pay much more than the £100 or much less than £100, because at the end of the day you're going to get £100 back plus the last coupon payment. So there's one thing to note. As the bonds get closer to maturity, the market value of the bond converges towards the par value, because remember, the last payment is the par value plus the last remaining coupon. And as you see, if we go down here, you can see the bonds that have got longer dated bonds. So if you look at the prices, they tend to increase. The one at the bottom here, you've got a 6% coupon that's due in 8 years from now. The price is very high. Remember, in 8 years time you're going to get £100 back, but the reason why this is very high is because every year you're going to get £6. So you might want to pay that now. 8 years time you're going to get £6 every year, and that might be more than the market value. Bear in mind this picture was taken in 2018. Here you also have a few images of much longer dated bonds, and as you can see, the one at the bottom there is going up to 2071, but the interest rate coupon's quite low, so that's why the price for this bond at 3.5% ends in 3 years before that one is much higher, because 3.5% is a good coupon given the current market rates at the moment. On Bloomberg, here is an example of a description summary of a UK debt product issued by the government. So we've got a few things on here. It just kind of tells you that's UK 3.25 to be paid back in 2044. You can see the price now is £135. You can see when it was issued in 2012. You can see how much of this bond actually issued, and here's the credit ratings. Typically UK debt is AAA credit rated, but they tend to be rated at the time of issue. So in 2012 the UK government may have lost its AAA rating, and there might be the one slightly lower. So that's what the security description of the bond will look like on Bloomberg. Here's an example of a corporate bond from Apple, and it is a callable bond. So it will tell you it's callable. You can see the word call there. The credit rating is AA+. You can see how much they raised at the time of issue in 2017. But what we notice, this is a 10-year bond. It was issued 2017 to end in 2027. When we talk about credit ratings, what do we mean? Well, you have there's 3 main credit rating agencies out there. that evaluate a company's creditworthiness and give them a rating. Here's a table summarising how they compare. When we say AAA, that's kind of very low default probability. That's what most Western countries would like to have, the likes of America and the UK. That's because they have the ability to tax their population. Anything below BBB is known as non-investment grade or speculative. Anything that's got BBB and above is what we would say is investment grade. So remember that distinguished boundary. BBB investment grade, BB non-investment grade. And if you're down here, D, that's a default, i.e. the bond has went in default, the company or the government did not pay the coupon. How do these operate? Well, typically the government issued by the Debt Management Office, and they could be issued to market makers, and then what they will do is they will buy them but then trade them on the secondary market. The secondary market is done by the likes of the London Stock Exchange in the UK. Now, we've talked about how the price differs, but how can we work out the bond price? Well, the price depends on a range of things. Depends on the coupon, so what's the interest, the simple interest payment of the bond, what's the par value, when does that par value run out, i.e. when's the maturity date, how many cash flows have you got left until the maturity, because some bonds just pay annually, but some bonds might pay quarterly or semi-annually. And also, what is the market rate at the moment, also known as the discount factor or yield to maturity. Other things to consider, there's obviously what is the base rates, what's the rate of inflation. We've talked about interest rate theory when it comes to liquidity preference, what's the credit risk involved, and if it's overseas, what's the foreign exchange rate risk. The formula, now this looks a bit naughty, but let's break it down. Here you have really what's known as a present value calculation, which we already covered in this module. So you have where you have C1, that's your first coupon payment, 1 plus the coupon rate to the power of 1. So this could be in the coupon payment at year 1, coupon payment at year 2, coupon payment at year 3, then the final coupon payment plus the par value at year N. So this is just the present value formula over and over again added to one another to work out what the bond price is based on the present value of all future cash flows is the terminology. So I've got an example here. So we have a 5-year bond, par value being 1,000, the coupon being 8%, but it's paid semi-annually. So that means every 6 months you'll get £40. So what you can see here is coupon payment 1, £40, the yield to maturity divided by 2, i.e. semi-annually, the second coupon payment, and so on all the way up to 10. There'll be 10 here because it's 5 years semi-annually. If the yield to maturity, the discount factor, is 7%, the price of this bond is 1,041. But if the yield to maturity increases, discount factor increases, the bond price drops. So note the inverse relationship. Here is an example of kind of discount rate sensitivity for different bonds depending on how long the bonds are. So if you have a 3-year bond over here or a 10-year bond over here with the same characteristics, so the same kind of coupon rate, but if the yield to maturity or the discount factor changes, you can see the first 3-year bond, you can see the price increases by £2.44, but for the 10-year bond, if the yield to maturity decreases, the bond price increases by much further. is £5.87. Here I have a spreadsheet example which you can have a play with. So we have a 5-year bond that pays annually, par value being £1,000 and a 5% coupon. So cash flow period 1 is £50, 2 £50, 3 £50, 4 £50. Then at the end of the bond, 5, cash flow number 5, you have the £1,000 par value plus the £50 coupon, £50 being 5% of 1,000. Now this row here is the price. So that is the present value of £50. So £50 to be received in 1 year's time today is worth £48.54. That's again present value 2 years, 3 years, 4 years, and the final present value of £1,050 to be received in 5 years' time is £905.74 in today's money. If you add all these up, you get the bond price. So to buy this 5-year bond with a coupon of 5% and the current discount rate of 3%, your bond price should be £1,091.59. The bottom half is something to do with what's known as Macaulay's duration. We'll cover this a lot more detail in the final year, but if you want to know more information on what this stands for, please read up Macaulay's duration. Essentially, this is the average weighted time for all cash flows to be received. So because this is a 5-year bond, the average time to receive all the cash flows, given the different payment income streams, is 4.5 years. But for this module, we're only interested up until this row here on how to calculate the bond price. You will not be assessed on the likes of Macaulay's duration for this module. To summarise how sensitive bond prices are, given the change in interest rates, if interest rates change, longer dated bonds, their price moves more. And the relationship between yield to maturity and price is known as a convex relationship. The curve is more pronounced for longer dated bonds than it is for shorter dated bonds. So just remember, there is a convex relationship between bond prices and yield to maturities, and that longer dated bonds relationship is more convex than shorter. So to summarise, there's an inverse relationship that's very important. Interest rates go up, bond prices go down. For longer dated bonds, if interest rates change, their price swings more. So they're kind of the key things to remember. Because it's fixed interest, if interest rates go up, bond prices go down, and vice versa. Longer dated bonds, their price is more sensitive to movement if interest rates change. Thank you for watching this summary video.